Welcome everyone to today's presentation. This presentation has been brought to you by the Shasta County Office of Education. We are Civitas Strategies, and today we will talk a little bit about some tax preparation strategies for childcare providers. My name is Carlos Vidaurre, and it's a pleasure for me to be facilitating this presentation today. Just a little bit about us, a little bit about Civitas Strategies. We have provided over 17,000 coaching interactions annually. Also, since 2020, we've helped providers reduce cost, increase revenue, and mitigate risk, totaling over $1.2 billion in combined impact. We have also supported the addition of more than 50,000 new childcare slots. We have partnered with businesses over 34 states and Washington, D.C., helping build the stronger, more resilient childcare businesses. Also, we have developed the Tried Pathway, which is a nationally recognized framework created with and for providers to build lasting business resilience. Having said that, let's do a quick disclaimer before we jump into the content. Just know that the information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. Also, the reproduction of this information and recording of this content, including the use of AI, are expressly prohibited. Only non-commercial uses of this work are permitted. Awesome. Now let's start with the content and what are we going to be covering in today's conversation. First, we're going to talk about why do my taxes matter? And what things should I consider? Um, what should I be a little bit more careful of? We were also are going to talk about what is a Schedule C and how do I use it. We're going to talk then about how do I prepare, file, and mitigate my taxes. And finally, we're going to mention some what we call tricky expenses, not because they are complex or too hard to understand, but um, types of expenses that maybe require some additional steps to get right. Providers who work through our tax education program pay an average of $7,600 less in taxes. So that's very, very significant. And that's not magic. That's the gap between what most providers are filing and what they are legally entitled to claim. So that's a lot of our focus is going to be on that. Um, we can uh, talk about some of our findings from things that we see working with many childcare businesses throughout the US. We have seen that about 83% of home based providers are not claiming business use of home. If you're familiar with business use of home, you know this can be a huge mistake. We also discovered cases where provider reported no expenses at all. Those might be extreme cases, but they happen. In the contrary, we also saw some cases where providers were claiming some uneligible expenses or miscategorizing some expenses, which can increase dramatically the risk of audit. So, throughout today's conversation, we will see how to avoid these mistakes, what to look for, and how to identify if something is wrong. For that, let's start talking about the Schedule C. And what is a Schedule C? While there are various tax forms you'll encounter as a business owner, let's focus on the Schedule C. This is a crucial document for reporting business income and expenses. Even if you work with a tax professional, understanding these basics will help you make informed decisions for your business. Schedule C is used to report income from sole proprietors as part of your personal tax return. Schedule C is mainly divided into the parts that we see here on screen. The first part, highlighted in red, is going to include all your income. So if you receive payments from families, if you receive payments from subsidy agencies, if you receive grants, any type of income that your business receive is going to go in that part one. Part two is going to be for expenses, and we really have to pay close attention to part two because this is where usually mistakes tend to happen. So we want to be very, very careful. We want to take a closer look to this section because here we have to categorize each expense from expenses like advertising to supplies. All business expenses are going to go here. Part three is where you are going to calculate your revenue and your profit or loss in some cases. Also, this is where we include our business use of home. We will talk a little bit more about that. Now, how do I start with my taxes? And I'm very, very excited to show you one of our resources that you will have access to. This is a guide that we have developed. It's free. It's a free tax guide, especially for home-based childcare providers. The Civitas Strategies Preparing for Tax Season Guide is a very, very good resource. It's updated every year and it's available at no cost. You can access it using our website, civstrat.com, or scanning that QR code on screen. It has things or include things from generic small business advice, including time space calculation, including a worksheet and a calculator. It has some TurboTax walkthrough guide available in English, Spanish, and Chinese as well. It has reference to the IRS shelter provided audit and many more things. Remember, it's free, no sign up required. So feel free to take advantage to this guide. Actually, a lot of the things that we're going to be covering throughout this presentation or resources that we're going to share come from this guide. So this is a very, very nice guide, probably one of the most comprehensive guides for taxes in childcare, in the childcare industry. Now, when it comes to taxes, if we want to simplify the whole concept of taxes, everything comes down to how much money did I make and how much money did I spend. So let's talk a little bit about how much money did I make and how to calculate that. If you already have an accounting system or you do any sort of bookkeeping throughout the year, you probably already know the answer to this question. You're probably already have your number, probably already calculated that. If not, no problem. We can make the process as straightforward as possible so we know quickly how much money did I make. And usually there are three things that we want to do. First, we want to gather your records, either tax forms like 1099s or your own bank records or your own documents. For example, if you have receipts you gave to parents, or if you have weekly or monthly payment logs or end of the year summaries, any document that reflects income that you had throughout the year, we are going to need it here to know exactly how much money you received. You can fill out a worksheet like this one to add them all up. This worksheet, again, you can find it in the guide that we just share. So this worksheet or this template really helps you make the process as straightforward as possible to know how much money did you make from the different sources of income that you might have. Then you will also need to know how much money did I spend, how much money did your business spend throughout the year. It's a similar process to what we were talking about income, but we do it with expenses. Again, if you have an accounting system, if you track your expenses weekly, monthly, this will be easy. You probably already have the answer for this. If not, again, no problem. You can use a worksheet like the one you see on screen that you can get from the guide and just get your documents, collect your documents, and add them all up. It's very critical that any proof of expenses show first that you paid the expense, second, the amount that you paid, the date you paid it, and a description of the item purchased or service received. To collect your expenses, start by gathering those records. Then you can categorize them, see depending if some expenses are for supplies, some expenses are for advertising, some expenses are um, for any expenses that you have in your business. Try to categorize them. You can use the categories. If you use the worksheet that we are sharing with you, you can use those categories, and that will make the process a lot easier. So once you have how much money did you make, how much money did you spend, you have a very good foundation to start understanding your taxes. So now we have that. Let's talk about some of of the tricky topics, tricky expensives that we will usually find and are very common when we work with childcare businesses. Um, For home-based providers, the next few slides are especially important for you. Centers, directors, or owners will flag what applies, particularly the home section coming up. So uh, these concepts can definitely apply to everyone in the childcare industry that has a childcare business. Let's start talking about the first tricky topic, the first hidden opportunity that we can find, and that's claiming or writing off vehicle expenses. As with all deductions, there are some very specific rules and guidelines that we want to follow. When we talk about vehicle expenses, we have to know that we can claim vehicle expenses that are related to the regular course of the business. We have to make sure, especially if we share the vehicle for business and personal use, that we keep records separated. They have to be shall related or business related in order to be considered a business expense. That's why it's important we separate personal use and business use. There is one primary rule that we can follow to know what trips are deductible, what trips are not deductible. That primary rule, that golden rule, is that trips can be for personal and business, and they are deductible if the primary purpose of the trip is business. For example, if you go to Costco to get supplies for the children, to get supplies for the business, and while you're there, you pick up a jar of pickles for yourself, that is a deductible trip because the primary purpose of the trip was for business. It's okay if you get something for yourself as long as we keep the primary purpose of the trip business related. Now, what happens if you're at the supermarket getting groceries for yourself, for your family, for the week? And you remember you also need something for the business. That's not a deductible trip because you are going there for reasons that are not business. So the primary purpose of the trip was not business. That's not a deductible trip. And when what do we mean? How do we deduct a deductible trip? We will find two different methods. The first method is called the actual expense method. The pros of this method and basically how it works is that you can deduct all expenses related to the vehicle. Again, if you share the vehicle between personal use and business use, we have to make sure we know what percentage of business use uh, is our vehicle. The cons is that this method has greater scrutiny and you have to keep record, keep documentation of all your vehicle expenses. So this requires a little bit more work than the alternative method, which is the standard mileage rate. The standard mileage rate for 2025 is 70 cents per mile. So this is basically the IRS telling you you can claim 70 cents for each mile you drive. So if you drive 1,000 miles, you can write off $700. For 2026, the rate will go up. So if you're starting to track miles this year, you will get 72.5 cents per mile. The IRS usually publish at the beginning of the year what the rate's going to be. So it is the trend is that it's going up every year, but we have to make sure we look at the IRS guidelines each year to know how much we're going to be able to claim per mile. Again, for 2025, we can claim 70 cents. For 2026, 72.5 cents per mile. The big pro of this method is that it's much easier to account for and it has a little bit of less scrutiny. Also, you not necessarily have to track personal miles as long as you're tracking business miles. So that makes bookkeeping a lot easier. Now, let's talk about the second tricky topic that we have for today, and that is food. Food costs in a childcare businesses are usually fully deductible. There are two exceptions that we're going to mention, but let's see the whole picture. Food for children in your care, 100% deductible. So if you give meals, if you give snacks, if you give breakfast, lunch, whatever meals you give to the children are 100% a business expense. If you have staff and you give food to staff, you will be able to deduct 50%. For food for your own children, they are considered personal meals, so they are not deductible. Then, how can we claim these expenses? And it's the logic is somewhat similar to what we saw for vehicle expenses. We have two methods. The first method is the actual expense method. Here you can claim 100% of the actual cost of food consumed by the children. Again, 50% for staff, 100% for children. Of course, you have to keep documentation, you have to keep a log of the meals, you have to keep the time of the meals as well. So we properly document that. We also have the standard rate method. And to simplify record keeping requirements, this is the optional standard meal and snack rate that family daycare providers may use. For centers, there is no way they can use this method. They have to use the actual expense method. But for family home daycares, they have the option to choose the standard rate method as well. How is this done? Basically, you keep track of the meals, type of meal, hour of the meal, and all that. And then you multiply that meal by the standard rate. So, very similar to what we were talking about when we mentioned how to deduct vehicle expenses. But here we do have to keep track of the type of meal, hour of the meal, because the rate change depending on the type of meal. Now, another hidden opportunity, tricky topic that we're going to mention here. It's business use of home. And for those running a licenses center, time space doesn't apply the same way. But there is one critical home rule that does, and that is that if you have a dedicated office at your center, you cannot also deduct a home office. The IRS requires your home office be your principal place of business, and since your center is the principal place of business, we cannot claim business use of home if that's the case. For home based providers, to figure out how much of your share expenses are deductible, you will use the time space calculation. In the time space calculation, you classify your space as either regular use or exclusive use. Regular use, also called share use sometimes, are areas used for the business and for personal. So you have a room you use for the children, you use for business, but also after the business is when the business is closed, you use it for personal purposes. That will be a shared use space or a regular use space. Exclusive use areas are areas that you use for the business and nothing more. So that's 100% business. If you have a room that you only use for the children or when the children are present, then that's an exclusive use area. Why is this important? Because home expenses can be fully deductible or can be partially deductible. Costs for exclusive use areas or direct business costs are likely to be fully deductible. For example, if you replace a tile in a basement only used for childcare, or installing a child-sized toilet, or having liability insurance, these will be fully deductible because they apply to exclusive use areas only. Then there are expenses that are going to be not fully deductible, they're going to be partially deductible. And those are the expenses that are going to apply the entire home or shared use areas. For example, replacing all the windows in your home. That not only affects exclusive use areas, it affects the entire home. So it's considered a shared expense. Also, repaving your driveway or paying for home insurance or paying your utility bills. All those kind of things are going to be partially deductible. Now, when we say partially, how do we know how much? How do we know how much we can take? How do we know how much we can write off our taxes? And that is going to be based on our time space calculation. Time space is different for each business, for each home, for every person, so we have to calculate it ourselves. Let's do an example. So this is a lot more straightforward to understand. First, we know that the business has a home that is 1,500 square feet. 500 square feet are exclusively used for childcare. 700 square feet are regularly used, So that's what we need for space percentage. Total square feet of the home, exclusive use square footage, regular use square footage. Then we also need our time. In this case, we know the business is open 10 hours a day and spends 1 hour before and after for prep and cleanup. So 10 hours is open, 1 hour before, 1 hour after. Those are 10 hours plus 2 hours. We have that we work 12 hours a day in the business. We also know that the business is closed 2 weeks a year. Let's do or let's start by solving that example and getting to what our time space calculation will be. And the math here might look a little bit intimidating, but the point is simple. This business can write off nearly half of her home expenses. So let's say if they pay $100 in utility each month, they will be able to claim $50 out of those 100. So that will apply for all home expenses from maintenance, repairs, property taxes, rent, mortgage interest, um, water, electricity, and all that. So all home expenses. In this example, they will be able to claim nearly half. How do we calculate this? And again, this is different for each business. It's different depending on your space, depending on your home, depending on how your business is set up. So we will have to calculate for each business. We will have to first divide the regular use square footage by the total square footage. Here is 700 over 1500. We get 46.6%. One tip here, and something that I do want to mention, is that outdoor areas don't count, but attached decks used regularly for childcare do. So we have to pay close attention to that. Then the step two is we get our time percentage. Basically, that's our total care hours divided by the total hours in a year. Those are 8,760. So in this case, our percentage of time will be around 34%. I'm skipping a few steps here, but I want to get to the point here. Then we multiply space times the time, we get around 16%. And finally, we add the exclusive use percentage. So at the end, doing all the math and all that, we get to around 49.2%. And that's the important part. That means this business will be able to claim 49.2% of their home expenses and write them off their business expenses. So that will definitely be a big deduction, and that will definitely save us a lot of money on taxes. So imagine deducting nearly half of her mortgage interest, deducting nearly half of her utilities, nearly half of her insurance, nearly half of their repairs, and all done following the IRS guidelines, making sure we are doing everything legally. So compare that to the 83% of providers who claim zero of business use of home expenses. That gap is real money that we have to make sure we take advantage of. The free Civitas guide that we mentioned a few slides back includes a time space spreadsheet that you can use instantly to calculate your business use of home. If you have the measurements, or you can do measurements real quick, you can plug it in the calculator that you can find in the guide, and you will be able to get your own time space calculation. Now, let's talk about the fourth hidden opportunity, and that is grant funding. The rule of thumb here is that you report the revenue, but you can deduct the expenses. So every grant that you receive counts as income, meaning that you have to report that revenue. Your revenue will increase when you get a grant, but also all the expenses that you do, if they are necessary and ordinary for the business, they are going to be deductible. Let's see some examples and let's see how can these affect your taxes. First, scenario one is that, let's say your revenue and expenses are the same in the year, meaning that if you receive a $10,000 grant and you spend those $10,000 in the same year, then your taxable income will not change, will not increase, because here in the US, we are taxed on our profits. So if you don't make any profit, there's nothing to be taxed on. So if you receive the same amount as you spent, there are no taxes on that. What if the revenue is more than the expense? Let's say we received $10,000 as a grant. We only spent 5,000 because either we save the remaining 5,000 or we want to spend them later maybe. The point is we only spent 5,000. Then in that case, our taxable income will increase because we will have technically a profit of $5,000. What if the expense was from previous years? Some grants allow us to reimburse ourselves to past expenses. In that case, we will not be able to claim those expenses again. So in your taxes, you will only be able to declare the income, not the expenses, because you already declared them in the previous year. So if we will declare them again, that will be double dipping, and that is not allowed. So if the grant was for reimbursement, please know that expenses made in a previous year are not going to be able to be deducted in this year. Now I want to share with you some tips and tricks for mitigating taxes. And here's the part that most providers don't know, that if you owe more in taxes than you expected, you still have a legal way to lower last year's tax bill. Right now, today, contributing to a retirement plan before April 15 counts as a deduction on your 2025 taxes. You are not changing anything that you already filed. You are making a contribution now that reduce what you owe. Again, contributions are tax deductible. So if you contribute now to a retirement plan, you can mitigate some of that tax impact. And here's the bonus. If you file for an extension, that deadline stretches to October 15. So if you need more time to figure out your profit before deciding how much to contribute, the extension buys you that runaway. So if you file for an extension again, you get till October 15 to decide some key options. And here again, you can find guidance on our retirement tool, is that you can contribute up to 25% of net self-employment earnings on a SEP IRA with a maximum of $7,000 for 2025. Also, a simple IRA up to $16,500 for 2025, or you also a solo 401k. So there are many options. For most home-based providers who haven't set up a plan yet, SEP IRA is the right starting point and is the easiest to open, has the highest contribution limit relative to income, and the deadline flexibility is a genuine advantage. Um, always make sure to talk with a financial institution or a CPA for actually setting up your plan. But know that these are very, very good options you have to lower your tax bill for last year. And you can still do it now. Again, till April 15 if you don't file an extension, till October 15 if you file an extension. And while you may not have options other than that retirement plan to mitigate last year taxes, there are a few things that you can do to start planning ahead for this year, next year, and so on. First thing you can consider is paying down debt. If your business has any debts, this could be a good opportunity to pay them down. Also, you can create a reserve fund. Um, Having a financial cushion can be beneficial for any business. So if you have higher profits and steady expenses, you can consider setting aside some of those profits in a reserve fund to cover future expenses or unexpected costs. You can also invest in business expansion, and by this we don't mean acquiring a bigger facility or expanding that way. Of course, that's possible if that aligns with your goals, but we refer more in invest in things like advertising, making sure you are investing in the right marketing or getting you're investing in your own quality, investing in supplies. All those kind of things are going to be business expenses that you can deduct. And also make sure to set a time for your mid-year tax review. Many businesses do this mid-year tax review anywhere from August to October, where you sit down, take a look at your finances, see how you're doing. And this way, you can know if you have to do any changes, you know if you're in the right path, or if you have any opportunities to do any additional things in order to save money on taxes. Another thing, when we talk about tax preparation, we also have some options. We have the option to work with a paid preparer, or we have the option for doing doing it ourselves, doing self preparation. Um, Usually, and our strong recommendation for most home-based providers is to prepare your own taxes, or at minimum, understand your return well enough to review it. And here's why. Software generated returns are audited less frequently than manually prepared ones. You know your business better than a preparer who sees you once a year. And with the right guide, you have everything you need. Self preparation saves you anywhere from $300 to $600, and it can be more depending on your area in prepare fees. That said, some of you will prefer to work with a paid preparer, and that can be a good choice as well, especially if your situation is complex, or if you have employees, or if you simply don't want to do it yourself. If you go that route, the next slide tells you exactly what to ask, so you're not handling your return to someone who has never seen a time space calculation. So, some questions you need to ask to a preparer. First, are you registered? That's crucial. All paid tax preparers must be registered with the IRS. They must have what we call a PTIN number. They cannot legally prepare your return without one. So if they don't have one, that's a big, big, big red flag. And so we want to make sure we ask that beforehand. Also, did they receive training? Have they worked with family childcare businesses? how well do they understand time space calculation? And of course, we don't necessarily want them to explain time space in big detail to us, but this is kind of a test we're going to make them to see if they are familiar with childcare businesses. They can say yes, they are familiar, but we want to make sure they understand the specific needs for home-based providers, and that time space it's a big one. So we want to make sure they understand that. Also, are they available for tax season? You may have questions. You may receive an IRS notice, or you might need to amend your return. A preparer who goes dark after April is a liability. Then you should ask, can you get a copy of your return? You are entitled to a complete copy of everything filed on your behalf. So keep it for at least 4 years, paper and digital. Also, finally, make sure all original documents you provide to your tax preparer are returned to you. They belong to you. You provide them for the preparation season, for tax season, but they should come back to you. Now, before we wrap up, I want to make sure you leave with the tools to actually act on everything covered today. We have two free resources to walk you through. The first one is the tax review app. Let me show it here. Um, this is what we call the tax review and improvement app. So if you have last year returns in front of you, or even a return from 2, 3 years ago, this app walks you through it line by line and flags anything that looks off against best practices for childcare providers. So it's very, very straightforward to use. You just follow the steps. It's best used if you have your returns with you. That way you can do an assessment on your own. The app will find red flags, will find areas of improvement. Finally, you will be able to generate a letter if you want to share those findings with the tax preparer, or if you want to keep them for your own records. Also, I want to share the proactive tax planning guide. Um, this is our free tax guide, and everything we covered today, plus worksheets that uh, you can find, will be accessible through this app. It will allow you to plan ahead, to estimate tax liability, especially valuable for providers who receive grant funding this year, because they will be able to see how that is going to impact their taxes. Again, all these tools are free for you to use, specifically designed for childcare providers. So make sure you take advantage of them. You can access them through the Civitas website or using the QR codes that we showed on screen. Now, if you have questions, if you want to get in touch with us, make sure to visit the Tom Copeland blog. There's a section called Ask the Experts where you can submit your question. You can be as detailed as you want. You can describe your situations, and we will make sure to give you the best answer possible to that question. Also, there's the chance that anyone or someone else asked that question before and it's already answered. So you can go and take a look at questions that have been posted there. It's a really, really nice blog specifically again for childcare providers. So make sure to take advantage of that resource as well. And finally, please check us out on YouTube. There are over 600 videos covering topics from monthly finance management to taxes to retirement and much more. Videos are available in English and Spanish. Also, you will get updates about Ask the Expert there. So please make sure to check us out on YouTube. And finally, just to wrap up, I really want to thank you all for being with us today. We really appreciate your time. Please make sure to stay in touch. Our website is www.sifstrat.com. Or email that where you can contact us is info@safestrat.com. You can also use the Tom Copeland blog to ask questions. And on behalf of Civitas, on behalf of the Shasta County Office of Education, I really thank you again for your time. We hope to see you next time. Thank you so much, and I hope you have a good day. Perfect. Thanks, Emily. I'll end the meeting. I think that was it. I think that went great. And I'm sure someone will contact you later. I really appreciate it. Thank you. Bye bye. Have a good day.